The economy is clearly weakening again as we move into the fall months, and it's unclear what Washington can do to help at this point. For more, let's bring in David Greenlaw. He's the chief U.S. fixed income economist for Morgan Stanley. Welcome back to InBusiness. It's good to have you here in person, David.
Pleasure to be here, Margaret.
So we talked pre-debt deal. Now you're here. We know somewhat of what we're going to be seeing in terms of at least a dollar amount of cuts. The way you've described it, this deal relies heavily on gimmicks and questionable baselines. It doesn't sound like you're more optimistic.
Yeah, so I don't think there's a lot of real long-term deficit reduction in there. It just shows how challenging it is to really address our budget problem if Medicare and Medicaid and the rest of entitlement programs and taxes are off the table. There's just not a lot left. So they cut pretty deeply into what's left, but it's stretched out over a long period of time. There's really not a lot of near-term cutting in this program.
Right, yeah, near-term cuts for 2012, it's like $20 billion around there.
Exactly.
But from your perspective, that $20 billion in cuts, it's not immediately damaging?
No, it's too small to have a meaningful impact on the economy. It's only about 0.1% of GDP. However, now that we have the debt ceiling resolution, there is more focus on the underlying performance of the economy, and that hasn't been very good recently.
No, and reaffirmed again today with a miss on non-manufacturing ISM.
We've got an employment report coming up on Friday. Obviously, a lot of question marks about the labor market at this point. I still think we'll have a better performance from the U.S. economy in the second half of the year than we had in the first half. Yesterday, we had some improvement in motor vehicle sales. Last night, the automakers released production schedules that showed they're on track for a pretty decent production boost in the third quarter. So I think some of those special factors will help us out near term. But to really sustain some underlying momentum in the economy going forward, we need the labor market to kick in, and that's still a big question mark.
Right, and to that point, we didn't get that support of more of a payroll tax holiday ongoing in this debt deal, and you point out that that's going to be expiring near term, so that could be a risk for the second half.
Yeah, absolutely. At Morgan Stanley, we've been focused on the potential impact of the expiring stimulus. So we have a payroll tax cut in place for 2011. We have extended unemployment benefits in place for 2011. At one point during the debt ceiling negotiations, all of that was wrapped into the legislation that would increase the debt ceiling and cut the budget longer term. At the end of the day, they couldn't deal with the stuff that complicated the base legislation. So that's going to have to be dealt with later if it is dealt with at all, and that creates a lot of uncertainty for the fiscal policy path in 2012. Fiscal policy path is not going to be dependent on the budget cutting in this program. It's going to be dependent on what happens with that expiring stimulus.
I want to ask you as well about the other thing we're bracing ourselves for, which is S&P to finally come out with their position on the credit quality of the country. Fitch and Moody's said near term, at least, we're not downgrading. Not a lot of conviction about where you're headed, but for now, we're not going to downgrade you. Do you think that that means S&P is going to fall in line with their assumptions?
I think it puts a little bit of pressure on S&P to fall in line. I think there are a wide range of views among investors on what S&P is going to do. We were just chatting this morning in some of our meetings that the clients who met with the S&P analysts seem to be much more convinced that there is going to be a downgrade.
Really?
Those who have not met with the analyst and are looking at the S&P the Moody's and Fitch announcements are much more uncertain about what's going to happen. So I think that S&P has tried to back away from their threat of a downgrade, and maybe this package was enough to get them to hold off for a period of time.
Well, Fitch, their analyst on our air, just talking to me an hour ago, saying that they're still assuming 2.5% GDP growth, supporting revenues via taxes to help us along here. Now that we're questioning the underlying economy, does that up the ante for a downgrade?
I think there is more justification for assuming a slower GDP growth path near term. But look, these long-run budget deficits are going to be based on the economy at some point getting back to full employment.
Yeah.
At some point getting the unemployment rate heading lower, back towards 6.5%, whatever you want to assume for a full employment unemployment rate. And so you really should base the assessment of the credit quality of the economy on it getting back to something reasonably close to what economists consider full employment over time.
You hear people say it's almost like an ugly contest these days, like who's worth Europe or the United States. What is your take about where we are headed here in the second half? I know you think the fundamental U.S. economy might be getting better, but it doesn't sound like the optimists in the bond market are with you.
Yeah, so one of the factors that we'd been expecting to provide support to the U.S. economy is trade, foreign trade. And in fact, that's been a source of disappointment in recent months. And part of it relates to the downshift in growth prospects for Europe. The rest of the global economy is still doing okay, and U.S. exports are well positioned to take advantage of some strength in foreign demand. But Europe raises some questions about the broader global demand outlook, and that could pose a risk for U.S. export performance.
David, it's always good talking to you. Thanks for coming on.
Pleasure, Margaret.